record. So for those people that can't make the webinar live, they were able to get the recording. Do a little bit of a screen share. So we've got a busy webinar today. So we've got just shy of 290 people that have actually registered for this webinar. So hopefully you should be able to see my screen at the moment, gents. Is that right?
We can, yeah.
Amazing. So before I introduce my wonderful guests today, thank you for everyone for coming on our regular Friday morning webinar, today titled IHT in a Post-Budget Landscape, What Now for Pensions? So just some general housekeeping for everybody today. The chat function is open. I can see people saying hello, so it's working. Fantastic. My business partner and PA are in the chat as well to keep an eye on absolutely everything. Can't do it without my amazing team. We should be running for about 50 minutes for this session, giving enough time for questions. So there are going to be some questions throughout. And we've also got 3 polls today as well. So we want to keep it interactive and want you to get as much value out of this webinar. Oh, look at me flipping through all those as quickly as that. But first of all, for those of you that don't know me, my name is Lewis Byford. I'm the co-founder of the Financial Planning Club. For those of you that don't know the Financial Planning Club, we've got 2 sides to our organisation. We have our community, which is a total free community covered of 5 core WhatsApp groups. Now, this does need to be updated because we have now gone over 1,600 members now, which we are so incredibly proud of to do that. And it's all about adding value to the industry in 5 core WhatsApp groups. And one of the team will drop that in there if you want to join the community that's relevant to your job role. Financial advisor, admin, paraplanner, and ops director as well on that. We also have our membership, which is for IFA owner managers, and really is about offering them opportunities for one-to-one support, one-to-one coaching, development to really reach the goals that you want to. For us, it's about really helping their businesses get to the level that they want to within their organization. Some of the things that we do, we look at, a 3-year business plan, give you that 12-month roadmap, and then break that down into 90-day roadmaps as well, and really giving you that full accountability. The main 4 areas that we cover, even though it's fully bespoke, it's mainly growth and strategy, know the vision that you're working towards, operational efficiency. So many financial planners are so inefficient, and that frustrates me. So we really want to make you as efficient as you can and use your team to really be as successful as you can be. Really looking at your client relation piece and your marketing. There is no business without a really strong marketing and business development process to really drive clients to your organization. And then one of the best parts of what clients love is that coaching piece, making you be the best advisor and the best owner manager that you can be. And for us, it's that long-term strategy. I will be putting a little note, well, I won't be, my amazing team will be, to actually score your business across these 4 areas. And we'll basically send you a bit of an overview of some top tips so you can start to improve your business across them 4 core areas, okay, which is fantastic. And a little bit more about the community pieces. Like I said, it's 5 bespoke WhatsApp groups, and that's broken down into bespoke study groups that are studying all the ROs and the AF exams as well, and also updates on our podcast and our webinars that we do every single week. Now, we can't do what we do without our amazing collaborators. We aren't experts in all of our fields, and we're very open and very, very transparent about that. The Financial Planning Club is all about bringing communities together, and we look at us as a bit like an aggregator of the industry, but we need wonderful experts that know their field inside and out. And obviously, we've got WAY's trustee today that I'll be doing an intro in very, very shortly. And my final bit before I do that introduction is we do have our business owner event that we're currently organising at the moment. So if you want to know a little bit more about that, we'll drop an email in and you can go on the waiting list for that, which would be great. It's the 8th of May, and that was the one that we did last October, which was a real great day for owner managers to get involved in. But enough about me. Today we've got the wonderful WAY Trustees as today's host. First of all, we've got Nathan. Nathan brings a unique perspective to his role as CEO at WAY Trustees, with experience as both a financial advisor and a provider. His insights into both sides of financial services has helped him create effective strategies for IHT planning. followed by the wonderful Mark. Mark takes on the role as Business Development Manager at Ways, has been in financial services since 1993, bringing expertise across technical, training, advising, and compliance roles to his position. Gents, thank you so much for joining us this morning.
Thanks for having us.
Pleasure.
Right, good morning, everybody. I've got a bit of sunshine here, which is nice to see, but apologies if you can't see the screen very well. I'll share my screen so it won't be a problem going forward. So this is the second session that we've run in the post-budget announcement world. And this is a deeper dive into pensions, really, following the last session back in December. So if you missed the first one, the idea behind this one is it's a follow-on session. So you will pick up things that aren't covered in the first one. I think the link is on the Financial Planning Club website. I don't know if Amanda's going to put one into the chat.
Absolutely. And I'll do a follow-up as well for everyone as well. The original recording, we'll get that in the email follow-up as well for everyone as well. So they've got that.
Great. So I've got the easy bit today because I'm just going to be doing the background piece and the introduction. Mark's going to be taking over after me, and he's going to be doing the kind of look at the sort of landscape for pensions following the announcements in October. And we're going to look at a case study actually and run through a possible scenario to the newfound pension dilemma. If anyone's got any questions, last time I was answering them in the chat while Mark was talking. There's also a Q&A slot which you can post to the sort of a public discussion point. I think Lewis might pick that up. We're going to be running a few polls. So yeah, so hopefully it'll be an interactive session and you'll get a lot out of the morning, the hour that we're with you. So a bit of context to why we're here talking to you in the first place. As I say, the pension announcements in the budget in April bringing pensions into the IHT net coming into place in April 2027. It's the biggest shift really in the planning landscape since pensions were largely outside the IHT net pre-2015. This is going to, as advisors, it's going to be a requirement to sort of revisit all the existing tax and estate planning arrangements that we've got into place. And to give you an idea of the scale of the issue, we asked some questions on registration. And one of them polled people to ask them, what percentage of their client base are going to be affected by the new pension landscape. And 72% of you said that this is going to affect more than half of the pensions that you're managing currently. So it's a big issue, big topic. But it's also an opportunity for to show value in the advice and service that we're delivering, us as and you as financial advisors. But also it's an opportunity to sort of retain assets under management and to build relationships with beneficiaries and the wider family. And you keep that long-term client relationship going after the death of your client, really. So, as I say, we did a session back in December. We had a very large amount of registrants, 500, slightly more than today. I think that's probably largely down to Lee was hosting it that time, Lewis, I think. He's clearly a bigger draw card. But one of the questions was we asked people what they would recommend their clients in terms of inheritance tax planning. And here you can see all the various different answers. Interestingly, flexible reversionary trust, which Mark's going to touch on today, only 5% of people named that as one of their go-to planning solutions. And I'm pleased to say that after the session, 94% said that they would be recommending flexible reversionary trusts after this event. So so hopefully you'll get a lot out of the morning. Don't know what happened to that other 6%, but they decided that they certainly wouldn't. But yeah, families come in all shapes and sizes. It's important to recognise the economic and social trends that shape all of our futures, and regardless of the family, the external pressures are the same. So one of the biggest sort of shifts that's happened in the last 100 years is life expectancy. And believe it or not, we've gone from average life expectancy of just over 50 years to where we are today, which is nearly 80 for men, just over 80 for women. Great news, of course. But it does cause greater uncertainty about the future. We all have extended retirement periods than we used to, so our money needs to stretch for longer. Rising costs of living in recent years, as we seem to be jumping from one crisis to the other. We've had the energy crisis, inflation. Can we sort of maintain the spending power of our sort of long-term assets? Property prices have fueled the rise in estate values for many years now, particularly where I'm speaking to you from in the southeast, bringing far more people into the scope of IHT than it was ever really intended to way back when. And younger generations face a big challenge, and that's getting on the property ladder in the first place, and that's something we'll touch on in a bit. This creates intergenerational dependence because there's a increasing reliance on inheritance from mum and dad and granny and granddad to get on things like the property ladder, particularly when younger generations, they're having a tough time at the moment. They're burdened by debt. We're talking about student debt as well, which never used to be a thing, and wages have remained pretty stagnant. And yeah, tax again. So believe it or not, we are on course to hit the highest tax burden since the Second World War. This is all a bit doom and gloom on a sunny Friday, I'm sure, but so there's a significant reliance on the bank of mum and dad. Why? Well, the 60 plus, their average worth is 430,000 thereabouts. They have 75% home ownership compared to 39% from 25 to 34-year-olds. And that's reducing all the time. It's a 20% drop in that age bracket since the year 2000. And approximately 42% of parents, grandparents have helped children, grandchildren on the property ladder. The average gift during lifetime is around the 25K mark. I know from my personal experience, me and my friends, we left uni a long time ago now, but we're back in the days when you could actually buy a flat in London. That's way out the reach for most people now. And a lot of us had some kind of help from mum and dad at some point in that process. Unfortunately, this means that people are living at home a lot longer than they traditionally did do. So 28% of 20 to 34-year-olds are still at home. And presently for us parents, and there's something now called the boomerang generation where they leave and they come back. They might have gone to university and come back and they just can't afford to sort of live independently. All those lines are blurred between independence where mum and dad are sort of helping out now and then with certain bits and bobs. And as I said earlier about the average cost of house prices continuously rising, it just creates a bigger problem. And the backdrop to all of this is the great shift in wealth that's going to happen over the next 20, 30 years. And these are figures that we've been, you hear about frequently, £5.5 trillion set to change hands. Inheritance tax take is ever increasing, 7 billion in the last calendar year. That's a £1 billion increase from the previous year. Average IHT bills are also on the up, 11.5% increase over the last 3 years. They're forecasting them to hit 15 billion in the next 10 years, helped by the frozen allowances and the changes in the announced in the budget. And as I say, we're all living a lot longer, and the over 65s is going to equate to a quarter of the population pretty much soon. And this all leads to a care crisis, and it's so expensive, the cost of care. So we're looking at, on average, 3,800 a month for care homes, and that's more if it's a nursing care home, where it could be as much as 5,300 average, even more if you're in London and the southeast. Well, what a gloomy picture we are painting here. But much of this wealth is going to pass on directly, either instructed by the will or worse, intestacy rules. And that gives it exposure to social impacts, which could see the erosion of family wealth down the generations. So as it's Valentine's Day, let's talk about divorce. I think 1 in 4 marriages sadly end that way.
God, so romantic, Nathan, on this very lovely day.
I know, I know. Who says romance is dead? So, and interestingly, there's a growing increase in what they term silver splitters, which is horrible, but it's an increase in sort of the later life generation getting divorced, and that's up to 75% in the last 20 years. It could be bankruptcy, it could be helping start new businesses up, and you could be perhaps losing 50% of the family money through divorce, whereas bankruptcy it could be the whole thing. Care home and care costs, always a big concern. We did a poll at the last event where 69% of advisors said this was a major concern for their clients. I know there's a bit of a trap where people are trying to sort of exclude their wealth from care fees assessment. I tend to think that's possibly a red herring because you probably want, when the time comes, to have the care that you can afford. But it's the planning around that what can be achieved, and having the funds to pay for care if you need to, unfortunately. And Mark's going to come on to that in a bit as well. Sideways disinheritance. We're all blended families just the norm these days. Stepchildren, step parents. You only have to look at our own royal family. And there's a danger that money intended originally for a certain class of beneficiaries ends up with another. And I always think of my friend's example where wealthy grandparents, sadly, his grandmother died relatively young, and his grandfather got remarried. He died. She went on to survive him for a good couple of decades, and over that time, because she inherited all of his wealth, sadly, the relationships declined with his family, and the whole estate ended up passing to her son, which was his stepson, and that was never really the intention of the family. And it just comes down to bad planning, really. And this transfer of wealth. So family wealth passing down the generations and subject to inheritance tax along the way. And this example just shows that if you start with £1 million, every year inheritance tax taking their share until you're left with less than half over 4 generations there. So we're going to have a poll before we hand over to Mark. Lewis, do you want to?
Yeah, absolutely. Here we go. So we're going to do the first one, which is social impact. So I'm going to launch that one now. So which of these social impacts do you feel your clients are most concerned about? And we've got number 1, which is divorce. Number 2, a bankruptcy. Sidewise disinheritance, care fee assessment of the beneficiary, intergenerational tax planning. We're coming in thick and fast now. 40% done, 50% participated. Lovely. Nice to see everyone's paying attention this morning on Valentine's Day. Must be something in the air.
They're all hopeful romantics.
They're all hopeful romantics. Yeah, they've got us 3 handsome devils on their 10 o'clock Friday morning.
I'm in no good place to talk. I was divorced by the time I was 30. So that's my overshare of the day.
You overshare, love that. I've just about got a boyfriend, so you know. Okay, so we're sitting at 80% now. So I'll end the poll so we can share that and discuss that. So let's share the results there. So hopefully you should all be able to see that. So over 70% is intergenerational tax planning, and then just shy of 40% is also about the care fees as well. So is that what you'd expect to see on that, Nathan and Mark, or what does that mean from your perspectives?
I thought divorce would be a bit higher, Mark. Did you?
Yeah, I mean, divorce is a big thing, really. I mean, divorce rates generally are on the increase, as Nathan's just mentioned. We are seeing far more blended families. And of course, the risk is that through divorce, you could lose family assets out of the family bloodline, which sort of ties in with the intergenerational tax planning piece.
But it is that inheritance tax. It's a kind of
the inheritance tax piece has got far worse following the budget, and therefore the focus is on the intergenerational tax planning and what work can be done there to protect family wealth, basically, from the tax piece.
Yeah.
Amazing. Right, I'll stop sharing that one. 2 more to go, ladies and gents. 2 more. There we go.
So I'm going to stop my share now and hand over to Mark.
Okay, if you bear with me a second, I will Just get my slide up.
Amazing.
Okay.
You seen? All good?
All good.
Yeah.
Right. Can everybody see that on the screen?
We can.
Yeah.
Okay, that's brilliant. Okay, well, thank you for that, Nathan. And good morning, everybody. It's great to see so many people join the session today. By way of a brief introduction, I'm one of the business development managers here at WAY, covering the south of the country. And along with my colleague John, who covers the north, we work together to support advisors with the inheritance tax legislation, with a particular focus in the use of trusts. Now, I must apologise in advance. I have a sore throat at the moment. It does feel like I've not stopped talking since budget day, so apologies if I have to, on occasions, clear my throat to keep speaking. So if you could bear with me on that one, that would be great. Now, pensions are a regulated area, and I'm not authorised to give financial or tax advice. I think the majority of the attendees today will be regulated advisors. However, for any others on the call today, do not take any action or refrain from any action based on the content of the presentation. I recommend that you take appropriate tax and financial advice from suitably qualified professionals and based on your own personal circumstances. So what I'm going to discuss today is the general principles and shouldn't be used for your own planning. Now, the opportunities and challenges that Nathan mentioned will become even more significant post-budget. Today, we'll take a closer look at the impact on pensions going forward, some unintended consequences, and maybe some solutions for consideration. It's important to note that at this stage, all we have is the commentary in the budget red book. We're yet to see any draft legislation, although the consultations are more about the proposed changes will work in practice and not whether or not the proposals should go ahead. Now, moving forward, we're likely to see a greater importance on lifetime gifting into trust. We're going to need more effective planning on first death and generally less reliance on the spousal exemption. Now, since the introduction of the transferable nil rate ban back in 2008, we've seen a general reduction in nil rate ban planning on first death and more reliance on the spousal exemption. Now, that's likely to change following the budget proposals. And of course, we need to consider these changes through the consumer duty lens. Now, the consumer duty rules include omissions and foreseeable harm. Foreseeable harm includes detrimental tax implications and access to money. And financial advisors cannot ignore investments such as ISAs or GIAs that will continue to accumulate money in the client's estate. What I refer to sometimes as the elephant in the room. We regularly see recommendations to use trusts and maybe BR to mitigate the IHT, but the client file's often completely silent on the ISA, GIA, and other investments that continue to grow within the estate at a 40% drag. That's an omission, and it could lead to foreseeable harm. If we take the ISA as the example, this could be sold down and the proceeds given to the trustees of a loan trust. The loan remains an asset of the client here, which is repayable on demand, so great access, just like the ISA. The main benefit is that all of the growth is now in the trust, immediately exempt from inheritance tax, rather than within the client's inheritance tax assessable estate. And of course, access to money could be critical in later life to pay for care. In the UK, the figure for over 65s requiring formal long-term care is estimated to be around 1 in 4. Now, that figure is for those who will need formal care services, such as residential care or nursing homes at some point in their lives. A report from Age UK and other similar organisations suggests that this number is growing as the population ages. By 2030, it's projected that the number of people in the UK requiring formal care will significantly increase due to the ageing demographic. Now, the use of discretionary trusts here could lead to foreseeable harm if a client finds they need care and is a self-funder but runs out of capital. So a flexible reversionary trust could help, providing access to capital to pay for that care ongoing and effectively ensuring against the cash flow modelling that's done from failing. Now, there are a number of benefits of using flexible interest in possession trusts over a plain discretionary trust, not least on the taxation. And now those points are probably beyond the scope of today's presentation, but please do reach out if you'd like any more information on that. Now, the pension funds currently sit outside of the estate for inheritance tax purposes, provided that they're not drawn from the scheme and allowed to accumulate unspent in the members' hands. And any undrawn pension on death would almost always be outside of the scope of inheritance tax. At worst, it would pass to the beneficiary's net of income tax, which is likely to be less costly than a 40% inheritance tax liability, provided the drawdown's managed sensibly. Often it's been treated as the last resort for income, favouring assets within the estate first. In addition, their succession is not directed by the provisions in a will, rather via the expression of wishes made to the scheme trustees. So what's changing? Well, as Nathan said, we've got this 6th of April 27 when unused pension funds and pension death benefits will be included in the deceased person's estate. The government aims to prevent pensions from being used primarily for inheritance. And of course, we don't have any draft legislation yet. It's not available. It's ongoing. However, what didn't change was tax relief on pensions. There was some discussion about that pre-budget, about whether that piece would change. And likewise, there's no change to the inter vivos period. We've still got a 7-year gifting cycle. There's no changes to the periodic charge regime, taper relief, the spousal exemption, or the gifts from normal expenditure. Although what did change was quite significant. And it's estimated that there'll be 40 billion of revenue over the next 20 years because of inheritance tax now being levied on pensions, largely fueled by previous DB transfers and clients looking for better death benefits. They are now going to get smashed by the new legislation. It's almost as if it's a perfect storm. Now, the Budget Red Book gives us little detail, really, other than unused pension funds and death benefits will be in a person's estate from April 27, which restores the principle that pensions should not be used for inheritance tax mitigation. The consultation period finished on the 22nd of January, but it may be several months yet before the government respond to that. The budget proposals, though, are likely to be introduced in one form or other, I expect, because, of course, there's this £40 billion carrot on offer. Now, the estate value is the aggregate of all property to which the deceased was beneficially entitled. This includes the free estate that will be directed by the will, the share of jointly owned property passing by succession, the value of any qualifying interest in possession, and in future, the value of undrawn pension benefits. Most importantly, the value of the estate, commonly referred to as E in the legislation, is calculated before applying exemptions, reliefs like business relief or agricultural property relief, or any other available nil rate bands. The spousal exemption is expected to be available if the surviving spouse is nominated as a beneficiary on the pension. Now, to assess the potential impact on pensions post-budget and in association with our external consultant, we've developed a pension calculator to factor in the proposed changes and model certain scenarios. Much of what I'll cover in the next 5 or 6 slides is the output from that calculator. And it's not meant to be, the calculator wasn't designed to be used for specific cases to a forensic level. It's more to give a slightly deeper dive into the impacts of this legislation in certain scenarios to help us then understand what that means. And from that, we can then move forward and look at options to plan for those changes. Now, as we'll see, the inclusion of undrawn pension funds in the estate will in many cases trigger multiple rounds of tax deductions from the pension plan and the general estate. Now, where the client's estate is already subject to inheritance tax, so they've got estate values above the allowances prior to the addition of this pension plan, the plan will clearly be subject to a 40% deduction. Now, subject to further updates from the government on the consultation period, we expect pension scheme administrators will become liable for reporting and paying any inheritance tax due. The pension scheme advisors and personal representatives will have to share information with each other. The personal representatives will have to inform the pension scheme administrators of the member's death. The pension scheme administrators will need to provide details of any unused pension funds. The personal representatives will have to calculate how much of the deceased nil rate band has to be apportioned to the pension, and the pension scheme administrators will calculate the IHT due on those unused pension funds. Now, all that within 6 months. And interest on unpaid inheritance tax after 6 months will be 8.5% per annum from April 25. So I suggest that lay persons will not want to be personal representatives. Maybe a good opportunity here for professional trustee services going forward. And the problems don't stop there. The pension scheme administrators will need to encash pension scheme assets. Now, there could be problems with the liquid assets owned by SAS and SIPs. The pension death benefits are not paid until the inheritance tax has been settled, and there will be delays and there will be less paid because of that. Is it now a case to build up investments in some pension schemes, perhaps, as part of the planning going forward? Now, in addition, most nil rate band will trusts use a wording that takes account of, say, lifetime gifts made within the 7 years of death. A proportion of the nil rate band will now be allocated to the pension, and that may not be covered in the current planning. So there will be a need for pension clients with pensions assets to review their wills going forward. In addition to the inheritance tax piece being levied on pensions post-April 27, we need to consider a death post-75 scenario. Now, this is where, in addition to the inheritance tax being levied, the beneficiaries will be subject to income tax at their highest marginal rate. Excuse me. Where a pension member dies pre-75 and a lump sum death benefits are paid, amounts over the member's lump sum and death benefit allowances are taxed as pension income on the recipient at their marginal rate, or at 45% if paid to a trust. Now, in this circumstance, you could, of course, restrict that lump sum to the available lump sum and death benefit allowance with a balance to draw down. There's no tax on designation to draw down, and no tax on withdrawals if the member dies under age 75. Where the beneficiary can draw the pension and suffer only basic rate income tax, the aggregate deduction on our calculator would be 52%. For higher rate tax-paying beneficiaries, that pushes out to 64%. And if they already have significant income and or withdraw the pension fund as a single lump sum, income tax could potentially be levied at 45%. And the maximum deduction from the pension plan in this scenario for additional rate paying beneficiaries is 67%, which was quite significant. Now, as bad as the 67% deduction sounds, it's far from the worst case scenario when we dial in the effect of the residence nil rate band. Because the value of the pension will affect the E value, it will influence the residence nil rate band assessment where E exceeds the £2 million taper threshold. We know that £1 of residence nil rate band is lost for every £2 that E exceeds that £2 million threshold. So in practice, tapering results in an additional 20% of inheritance tax within the taper range. That's between 2 million and 2.3 million for a single person, or 2.7 million upon the second death of a couple, where the residence nil rate band on the first to die is also available. If we factor in that deduction to the previous calculations of inheritance tax and income tax, we find the total percentage of the pension fund deducted from the overall estate could be 72% for basic rate taxpayers, 84% for higher rate taxpayers, and 87% for additional rate taxpayers. I mean, that really is a seismic shift in the piece here. That 87% actually could be pushed out to just under 92% if we were to dial in the loss of a personal allowance. So it just keeps getting worse. And of course, this is all comes off the back of a budget for fairness.
There's a question coming from Joanne here, Mark. I don't know whether Nathan wants to answer it in the chat or not, but it's a would funds held in a loan trust be considered in means testing for care?
The loan remains an asset of the settler in this case. They've only loaned assets to the trustees of the loan trust. So they are regarded in their estate for IHT, and therefore I would suggest they're on the table for any care fee assessment. Yeah.
Thank you.
Okay, so moving on, pre-registration, we asked a couple of questions. This is one of those. We asked what percentage of your clients will lose or have their residence nil rate band tapered following the budget announcements. Now, we had 180 respondents to this question, and then 154 of those, so roughly 86%, said they had clients that would lose or have the residence nil rate band tapered away. And 126 of those, so roughly 70%, said up to 50% of their clients would be affected. And that confirms really what many of us have been thinking, in that the pension changes will have a sizable effect on clients here. So thank you, Lewis. We've got another poll question there for people to take part in.
There we go. So now we have quantified the potential impact on the residual nil tax band. How likely are you to undertake positive action to mitigate this effect? I'd love to find out more about these not likely individuals. Okay, I want to get to about 80% of people. So we're at 70 now. So find your mice, everyone, because I know what it's like. You're trying to find your mice, trying to then click which one you want. Are at 75%. 3% to go, team. I believe we can do this. Come on, I believe we can do this. 1% to go now. Not likely. So Neil Jones has come back around the not likely statement. We only had 2 people click on not likely. So he's put already tapered and removed from that question there, Mark. So does that make sense from your side? Amazing. So we're just shy of 80. So if I share the results for everybody.
Okay, you happy for me to move on?
Yeah, absolutely.
Okay. Just get that down. Okay, so another way to look at the impact of these the budget announcements is to consider the effect on the overall returns generated across the lifetime of the pension. So that would include the saving and accumulation phase, the drawdown phase, and ending with the inheritance of any remaining funds on death. So to start, if we imagine saving into a pension for 15 years and claiming 20% basic rate tax relief on the contributions, we follow this accumulation phase by drawing the fund down to zero over a further 15 years and paying basic rate tax on the whole of the drawings. Now, the tax rebates and deductions in this example are therefore effectively a wash. Under this scenario, there would be no boost to the rate of return. If the investments return 5% per annum over the whole period, the true return shown in our model would also be 5%. There would be a boost to this 5% figure if we had higher rate tax relief on the way in and only basic rate relief on the way out. Okay, but the scenario we're considering at the moment is where the pension's fully exhausted just in time for death, will of course be unaffected by the new rules, and the tax efficiency of the pension wrapper does remain compelling where the fund is used to provide drawings for member in their lifetime. Of course, many funds won't be fully drawn by the time of death. This could be for any number of reasons, ranging from death at a younger age than hoped to planned use as a succession vehicle. For many pension savers, any surplus remaining upon death is likely to arise from taking a necessarily cautious approach to reflect the fact that the individual saver bears all the risk with respect to setting appropriate contribution levels and managing investment risk and longevity risk. If we rerun the model, keeping the accumulation phase the same, but removing the drawings and allowing the pension to coast and accrue gains for 15 years, so that the whole of the pension fund remains on death, and that death we'll assume occurs after the 6th of April and at an age over 75. Now, following an IHT charge of 40% and then drawn income tax at 40%, which is reasonable if the whole sum is taken in a single year, our 5% investment return here is now shredded to just over 1.5%. So that's the effect of inheritance tax being levied and the dependent drawing that pension at a 40% rate of tax. Okay. Now, the most painful scenario is where the addition of the pension fund value wipes out the residence nil rate band. In this example, the client's estate is, say, worth around 2 million on second death, and the pension fund adds another 700,000 to span the tapering band. Now, this results in an effective inheritance tax rate of 60% across that part of the estate and the pension. Our model now shows an annual rate of return of minus 2%. That's 30 years of saving, capturing 5% per annum investment returns to end up with less than you've put in, which is devastating. Now, budget for fairness, I've mentioned that before. The Red Book states the government's making the inheritance tax system fairer by applying inheritance tax to unspent pension bonds. Now, a collaborative approach will be required to look at the interface of pensions and estate planning. I guess the question many advisors have been asking themselves is, do I flip or stick? Where the client is on their retirement journey may influence that decision making. For those young enough, pensions will remain the primary source of income in retirement, whilst for those older clients, perhaps close to or already in retirement, reverting the pension income and turning to the other assets to mitigate IHT, or do you stick continuing to draw income from other assets and use different planning opportunities for the pension? What is clear is that apathy has become a whole lot more expensive for clients. We may well see an increase to nil rate band planning to avoid bunching of assets in the estate of the survivor, which will generally be unhelpful post-budget. The general principle going forward will be to lock in what you can when you can, and that includes the residence nil rate band on first death where appropriate. For those clients where you flip the planning and turn to the other assets to mitigate IHT, the use of trusts will be critical to effective estate planning. Now, WAY have a flexible trust for capital and a loan trust, but they're often used together to optimize the tax planning and, importantly, deal with the elephant in the room that we covered earlier. Now, for those clients who you elect to stick, Section 21 of the Inheritance Tax Act 1984 will be of interest. So the schemes that are affected, all registered pension schemes, QNUPs, guaranteed or protected annuities with a value on death. So if a client's bought an annuity with a 10-year guarantee period, die in year 5, the balance of that guarantee will be paid out. That will be captured by these new proposals. Some planning considerations. We could do nothing, of course. Some clients are not bothered about inheritance tax or the changes that we've seen. That is the simplest option, but the least tax efficient. You could stick or flip, reassess the situation, and perhaps draw down on pensions going forward. You could insure the IHT liability. So clients can insure rather than pay the IHT liability or mitigate it to make sure that their loved ones are left with sufficient after the tax has been levied. Again, you're probably looking at whole of life or maybe fixed term contracts here, depending on the circumstances. You could move offshore. We may see an increase in number of retirees moving offshore, transferring to a non-UK wrapper. After 10 years, the IHT exposure would fall away. There are many considerations here, and it's important that the tax tail doesn't wag the proverbial dog. Some countries don't have an IHT regime, but have some other arrangement on death. Where two countries charge tax on the same balance, you can often get double taxation relief to make sure you're not paying two lots of tax on the same thing. But that generally does require the tax in each country to be the same. So if the two charges on death are different, there might not be any relief here and could result in a worse position overall. And of course, you could consider gifting which is likely to be the most effective for those families and clients that want to mitigate the inheritance tax. Options on gifting. We need to take action during lifetime, really. We know that spending money is the most efficient way to mitigate an inheritance tax liability. There are limits to that spending, though, and clients may already be doing a good job on spending, and having a pension worth several £100,000 drop into account might be, a bit too far. On the gifting side, we could turn to the tax-free cash. Not forgetting that the tax-free cash dies with the client. So taking that pre-75 and perhaps gifting it might be a reasonable consideration. Of course, we could work with surplus income. Giving that away gives us an immediate exemption to IHT. Or you could turn to other assets. If you flip the planning, drawing the pension income now, and you've got capital in ISAs and GIAs, then we can look to those assets to gift. Of course, gifts ordinarily are subject to the 7-year rule, whether you gift them direct or to a trust. So we got that to think about. Surplus income, it does give an immediate exemption and could be very valuable here for these pension clients. There's lots of reasons why gifting direct perhaps wouldn't be regarded as best practice. Again, today we need to be mindful not to load up the next generation. We've already touched on the point that bunching of assets in the estate is going to be unhelpful. So generally we need to put our estate planning hats on here and potentially consider the use of trusts. We don't want to force that value into the beneficiary's estate, that then becoming subject to social impacts. And of course, if it's in their IHT accessible estate, the Chancellor will be happy. The general principle I'd like to talk about is once it's out, keep it out. So we do good work removing assets from a client's IHT accessible estate. We should really do everything we can to keep those assets out of the beneficiary's IHT accessible estate. And that's going to become even more important going forward following these budget announcements.
A couple of questions coming in, Mark, that I think are relevant at this point. If you'd like to answer, or do you want to wait till the end?
I don't mind, depends what they are.
Yeah?
Yeah.
So if we start off with Neil, so any issues with someone stripping income from a pension and gifting using the NEOI exemption?
Using the what exemption?
NEOI?
The gifts from normal expenditure rules, Mark.
Okay, yeah, no, there's no real issue with that, none whatsoever. So, I mean, the legislation is relatively broad. We are coming on to this bit here, but if potentially they could create surplus income, and as long as it is surplus income and they've got genuine income from other sources that they're leaning on, and we can demonstrate that it's surplus income, then you can give that way and qualify for an immediate exemption. Whether you give that direct or trust is for further consideration. So there's no issue here, and in fact, I come on to those aspects on this slide in a little bit further. So I might be able to answer that more fully in a second, if that's okay.
Amazing.
Okay, so this normal expenditure out of income exemption, what's often referred to as gifts out of income for short, is an extremely important exemption for advisors. It was introduced in 1984. It is vastly underutilised within the industry. Importantly, it is an exemption that works with trusts and provides this immediate exemption to IHT, providing the rules are met. Now, WAY do have a flexible trust specifically written for this legislation. We've had it for many years, so it's not something we've thought of post-budget. This has been part of our lineup, if you like, of trusts for a long time. So it's important to note here, we're talking about income and not capital. So we can't use the 5% return of capital on bonds. We can't use any output from a DGT, because that's all capital. Nothing to do with that. This is all about surplus income. So the settler can give surplus income away, hopefully to trust. And as long as it meets the rules, it will be immediately exempt. Excuse me. Those rules are that it should be regular, or at least the intention to be regular, from surplus net income, although interestingly, we can use income from ISAs, so it doesn't technically have to be net of tax, and it should not impact the standard of living of the donor. So there's no point giving away surplus income and then finding you need to lean on capital to get through the year. That wouldn't be in the spirit of the legislation. And the idea is that every year the client makes an assessment of surplus income and gives that away to trust. Okay? When they do, it's all immediately exempt. So there's no 7-year clock here. So HMRC will allow you to use the surplus income from this tax year on what we call the current year basis and potentially go back 2 tax years. Now, for example, when you looked at those tax years, if that figure was £100,000, the client could settle all of that today and get an immediate £40,000 saving on inheritance tax. And then typically we would review that annually going forward to say, okay, did you have any surplus income? You know, what figure is that? Would you like to give any of that surplus income away? Okay. And then it would be annually thereafter. Now, these are exempt transfers. So as I've said, they're not subject to the nil rate band. So you're only limited by the surplus income the client has. So if we take professional footballers, for example, they have, you know, enormous sums of surplus income. You know, we're only limited by their earnings. We're not limited by the nil rate band. However, the trust structure is subject to periodic charges. And if using other trusts as part of the planning here, the order of gifting will be key. It's important to consider this in the round before any trust framework is settled. Exempt transfers that we're talking about here do not accumulate with chargeable transfers. So the general principle will be to settle this trust ahead of any chargeable lifetime transfers. Okay, so we do the exempt transfers first, followed by a chargeable lifetime transfer that was settled on a separate day. Importantly. Now, getting that order of gifting correct could save up to £19,500 per trust every 10 years. But we have to do the heavy lifting for that today before any framework is established. That'll help us with the planning in 10 years' time. Now, good record keeping is essential here. We often recommend that, excuse me, IHT 403 is used. This is the form that's submitted to HMRC following death of a client to account for gifts in the 7 years prior to death. On the last page of that document, the IHT 403, is an income and expenditure summary, if you like, on an annual basis. So it allows you to say, this is the income, these are my outgoings, this is the surplus income that I had that year, this is how much I'm gifting away, you know, to direct or into trust. Okay, and we just keep doing that every year because we don't know when the client's going to die. And of course, you'll only have to report surplus income gifts that fell within 7 years of the client's death. Okay. Now, clients who were previously ignoring the pension pots, which comes back to the question that we just had, and they were relying on income for other sources, can draw down on these pensions and create that surplus income and give that away to trust and benefit from this immediate exemption to IHT. Now, the tax position is a consideration. However, with the effective rate on pensions potentially as high as 87% for additional tax-paying dependents, clients sitting on the hands is a really costlier option. And don't forget, in addition to the immediate exemption with this type of planning on the value settled into the trust, all of the growth within the trust is outside of the client's estate and immediately exempt from IHT. Now, for a man aged 65 today, that's potentially IHT-free growth for just over 18 years and just over 21 years for a lady. And those figures were taken from the ONS tables. So considered in the round, the 45% income tax charge, perhaps in that scenario, seems palatable. Now, the sweet spot here is where you've had a client, pension client, die pre-75, and the dependent is currently ignoring the pension under the current rules. So they're using it as an IHT mitigation vehicle. Now here, the dependent can turn on and create that income. It'll be tax-free and get the immediate exemption to inheritance tax. And using the WAY Inherited Gift from Income Trust introduces some additional benefits in addition to the immediate exemption. Now the settler, because it's a flexible trust, the settler retains access to the trust capital should their circumstances change in the future. There's a 50% reversion in year 5 available and another 50% reversion in year 10. Now, for all the trusts of this nature we have as a business on our books. No one's ever taken money out of it. They tend to be the wealthier clients. They've got plenty of other capital and income to rely on elsewhere. So when they get to year 5, they could take 50% of the value of the trust back. Invariably, they don't, but we defer it to year 6. And we keep pushing that and doing that annually down the line. At year 10, it'll join up with the other 50%, and there's 100% available. And they're still not likely to need any capital back out of this trust on the 10th anniversary. So we will just defer that into year 11, 12, 13, and so on. Okay. By doing that, we avoid the income tax position on pension benefits death post 75. Because of course the member might die pre-75. The dependent can draw capital and income tax free. If that dependent then dies post 75, it's going to trip that pension into the income tax situation for post death 75. And of course, we can loan assets or appoint capital to beneficiaries at any time. So even though the settler doesn't get access potentially until the 5th anniversary, if we were 3.5 years in and they wanted to pass some assets to a beneficiary, as advisors, you just have a discussion about, okay, is there a need to loan the capital as opposed to appointing it out, making a note of it and moving forward. Okay, pre-registration, we had another question. Do you recommend clients use gifts from normal expenditure rules to remove surplus income from the estate? I was quite surprised at this because I know from my experience, generally, it is vastly underutilized. However, there were 170 respondents to this particular question, and 70% said yes, they did, which is a fantastic figure. So obviously, we've got very good advisors on the call today who are aware of the legislation and use it appropriately, which is fantastic. I think you've got another poll question for us, Lewis, please.
We have indeed. So while I run that, if you two want to run your eyes over the questions in the chat, that would be really, really helpful. Because some of them are, I don't know if they've been answered or not. So if you can just have a little look through that one while I launch the list. So you should all have a poll come up, everyone. After hearing us present, would you recommend using a gift form income trust for your clients? So again, I'd like to get around 80% of you to get that filled in. So find your mouses, yes or no, easy peasy. I do have a question answer that's coming on in the Q&A from Anonymous, and it basically says, and either one of you can answer this, for clients who are drawing down on assets with non-pension assets, in addition to pensions, we have typically targeted first those assets that result in low tax as a result of withdrawal. Example, ISAs. But given the IHT on pensions from April 2027, is there a strong argument to retain the ISAs and draw the taxable element of the pension on the basis that they will only pay income tax on withdrawals during their lifetime, but beneficiaries and estate could jointly pay for more tax on behalf of death?
Okay. Flipping the planning and turning to the pension to draw income is certainly an option going forward. And again,
Yep.
depending on where the client is in their retirement planning journey, that may well be a viable option. Drawing the pension. Obviously, we need to be mindful that whatever it is in the pension post April 27 will be subject to the new rules here. But that does mean it might free up other assets within the estate, like the ISA and GIA, so that you can work with it more traditionally, and putting typically up to 325 into trust and recycling that every 7 years for the client. Again, if they've got substantial ISAs, as I've already commented on, this is the elephant in the room that we see. There is a case here to say, okay, well, let's be smart about this. There's no point in me continuing to grow those ISA assets in your estate at a 40% drag. It's sensible to at least have the discussion, and Consumer Duty suggests that we should be having the discussion about selling those ISA assets down in this example, loaning them or giving them to the trustees of a loan trust and getting all that growth now immediately exempt. So wherever you're drawing the income from, if it's surplus, considering the tax position on those drawings is definitely something to consider.
Yeah, amazing. And results from the poll, 96%, which is amazing. Sounds
Excellent.
good.
Okay.
There's
Any
a lot of debate on the chat. Sorry, Lewis. Just
Go on,
about
please. I'm going to
tax-free
say,
cash,
yeah, let's go through the chat questions if you wouldn't mind.
and how the tax-free cash is treated as income or capital. And John's doing a great job on answering everybody on the chat. Thank you, John.
Oh, thank you, John. That's very good. Okay. Did you want me to pass some comment on that, Nathan?
Well, it might be, yeah, if it's to open it up if people aren't following the chat.
Okay. I think you can, if you're drawing regular, phased drawdown, and part of that is made up of tax-free cash and income. The legislation states that it needs to be in the manner of income. Okay, so in that scenario where we had dependents' pension, the member died pre-75, so that dependent could draw all of that capital or income as in one go, tax-free. Some advisors have said, well, okay, can I draw it all tax-free, and let's just drop it into this gift from income trust and get an immediate exemption straight away. That doesn't really fit with the legislation. It's not in the spirit of the legislation. It comes back to, does it look like a duck, walk like a duck, and sound like a duck? It's probably a duck. So we need the income to look like income. So our suggestion there is, in that scenario where we've got a dependent pension, death was pre-75, then the suggestion was we've got roughly 2 years to run until April 27. Let's draw that over 24 segments up to that legislation. We'd rely on the gifts from surplus income legislation to make it all immediately exempt, and we'd effectively move that pension from a currently IHT-free zone up until April 27 into a trust which will be immediately exempt from IHT. So it's important. Again, HMRC don't define income, so this is an accountancy definition of income, really. And it needs to look like income and be in the manner of income. So that's the driver for it, really. And of course, we don't want to do anything that sort of pushes the bounds a little bit. We want to keep within the spirit of the legislation where we can. But I hope that answers the question. Does it? Forget what the question was.
No, it mirrors what John said on the chat as well.
Oh, okay, excellent. Okay, I'm conscious I'm perhaps running a little bit behind. Bear with me a second. Okay, now an important, just rounding up really, so an important benefit of using trusts is the ability to protect assets, as we just discussed. And it's worth pointing out that not all flexible trusts are created equally. A fully workable loan facility is critical to protecting wealth in the hands of the beneficiary and enabling this intergenerational tax planning, which is hugely beneficial for families. The loan remains an asset of the trust and a debt of the beneficiary and offers protection in various situations. These loans are typically made on an interest-free basis and can remain outstanding for the lifetime of the beneficiary. So these are the social impacts that Nathan touched on, I think, earlier in the presentation. If we've got a trust, ideally we would loan assets to the beneficial class. And if we take divorce, for example, if we loaned £1 million to the beneficiary, they subsequently ended up getting divorced. Well, there's an element of protection here now because that loan is not an asset of the beneficiary, it's a debt. Okay, it's important to note that without loaning trust assets to the beneficiary, there's no protection from divorce whatsoever. With the trust loaning assets, there is an element. So I can't say it'll guarantee to protect from that divorce piece, but without the loan, there's no protection whatsoever. There's little case law in this area, actually. I think there was a case back in 2023 where a judge deemed the trust to be an extension of the individual's bank account. There were many factors here, not least that lay trustees that just rolled over and weren't really meeting their fiduciary duties, I think. And that trust was deemed on the divorce table. So the point is, loaning trust assets to beneficiaries could be highly beneficial to protecting those assets from divorce. Otherwise, they're going to be divided on divorce and you're going to lose probably half of that inheritance out of the family bloodline. Likewise, in bankruptcy, if we've loaned money to them, potentially all of that, inheritance, if it wasn't loaned, was at risk. If you've loaned it, there's an element of protection. And the big one here is the intergenerational tax piece. So I'll skip the others at the minute. And we'll move to the next slide. So we saw from Nathan's earlier presentation how passing assets direct is the quickest way to erode family wealth. I've met a few advisors over the years that have told me they make a small fortune for their clients, and I wonder if this is what they meant. Using trusts with facilities, loan facilities, makes a huge difference in this area and can be illustrated by running the comparison side by side. Now, if we loan £1 million to the first generation following, that loan is an asset of the trust and a debt of the beneficiary, often made on an interest-free basis and can remain outstanding. So that beneficiary does what they want now with that loan within reason. When the beneficiary dies, the executors of their estate will repay that loan. And a couple of things happen here now. So by repaying that loan, it nets off the deceased beneficiary's estate. So we've inadvertently saved that deceased beneficiary's estate £400,000 in inheritance tax here. So it's a really smart way to do things. And that loan now back in the original trust is available again for future beneficiaries and future generations. And if we keep loaning the assets between these generations, we avoid further assessment of inheritance tax for potentially up to 125 years in England and Wales. And the perpetuity period, I think, is still 80 years in Scotland and Northern Ireland. So if we run this principle forward now for the 4 generations, we can see the 4th generation is still benefiting from £1 million. That's over £500,000 of added value because we've chosen to use a trust, and importantly, make sure the trust has got the ability to make loans so we can protect those assets in the hands of the beneficiary and get into this highly valuable intergenerational tax planning. And when I was advising and having this conversation with clients, these protecting assets in intergenerational piece might not be immediately obvious, but when you mention it to them, they absolutely love it. And these things are typically become more important to the client than the inheritance tax piece that they perhaps originally engaged you for. So it's definitely worth mentioning these to clients in your conversations, and they really get switched on when you have these conversations. Okay, very briefly, to cover the WAY proposition, we've got 3 trust frameworks in principle. We've got a flexible trust for capital, which is called the Inherited Gift Trust. We've got a flexible trust for surplus income, as we discussed, called the Inherited Gifts from Income Trust. And we've got a loan trust. Now, we are a little bit different in the marketplace to other trust providers. Our trusts invest directly into collectives, so we are CGT accessible, not income tax accessible. And basically, that means that for the vast majority of clients who are UK-based income taxpayers, we should be able to offer a more tax-efficient transfer of wealth. There's about 34 million income taxpayers in the UK. Only 1% of those actually use their capital gains tax allowances. So the principle is it's easier to find a beneficiary that hasn't used their capital gains tax allowance than it is to find a beneficiary that doesn't pay income tax. And that's it in a nutshell. All of the trusts that we have benefit from this full workable loan facility, so we can protect wealth and offer intergenerational tax planning. The trust assets can be held and run on a range of platforms or with DFMs. Once we've settled the trust, it's effectively a trustee investment, so we can work with individual preferences or business preferences, etc. And of course, all of these trusts are underpinned by our professional trustee service. And if I briefly cover that, so this professional trustee service that we offer covers TRS registration, ongoing maintenance of that register, and the annual legal declarations. We liaise with financial advisors prior to each anniversary, regarding the reversions and any other trust business. We draft all documents that might be required, including loan agreements, to make sure that everything runs smoothly. We will compile and submit annual tax returns annually as required. We also take care of the periodic charge piece every 10th year. We will ensure that CGT allowances are used, so we got maximum tax efficiency. Hopefully that means there's easier administration for the financial advisors and their support teams. And the last one, of course, which is what we're all about, is hopefully that will help drive better client outcomes. And the advisors here can, sleep well at night, not worrying about what bits of trust administration they've missed, overlooked, if there's any fines coming. So it just gives them the armchair ride, lets them focus on the investment piece, of course, they are advising us as professional trustees. We are the client for which they charge the trust their ongoing advice. That's me largely done. I do apologise, I've gone over slightly. They're my colleagues on the screen there and our contact details. So please do reach out if you want any follow-up questions or discuss individual cases. I think we've got a compliance slide there. So that's me done. Thank you for listening. Apologies for my throat issues. I'll hand back to you, Lewis.
Amazing. Thank you so much, everyone. Really, really enjoyed that. Like I said, everything's been recorded, so we'll get that all uploaded to YouTube and across to everyone, so you can look at that recording. All the contact details for everyone involved at Ways will be available as well. And gents, thank you so much. Afterwards, there'll be a short slide for you to just fill in your feedback. Feedback for us is super important. We always want to have the best webinars that we can. And thank you all so much, gents. It's been a pleasure as always, and I'll speak to you both very soon.
Thanks so much.
Thank you, Lewis.
Thank you. See you later, everyone. Thank you.
Thank you. Bye-bye.